Hello, my name is Michael Grandy. I'm a professor of accounting at Providence College and teaching managerial accounting. Today we're going to we'll go through some problem solutions with regard to activity-based costing. And we're using the Kimmel 7th edition financial accounting textbook. And again, this is activity-based costing and specifically Chapter 17. Let me begin to share my screen with you. And for my students, these solutions are on Sakai as well, but I want to walk through them as we would in the classroom. So the first exercise that we're looking at is exercise from Chapter 17, exercise number 1. And let's read it and talk about it and then look at the solution. But let's remember what activity-based costing is. It's using multiple activity rates to allocate manufacturing overhead to our product. So we have traditional costing and we have activity-based costing. Traditional costing uses one single plant-wide predetermined overhead rate to allocate manufacturing overhead to its product. Activity-based costing uses multiple activity rates to allocate overhead to its product. The idea being that the more activity rates you use, the more precise and the more accurate you become in the allocation of overhead between your products or among your products. Now, this is not a question of how direct materials and direct labor are traced to our product. Those items are not in question. We have a pretty good handle on direct materials and direct labor. The question becomes, how is manufacturing overhead allocated to our products? The goal being to come up with as precise a method as possible. So let's take a look at exercise 1. It says here, Saddle Inc. has 2 types of handbags, standard and custom. The controller has decided to use a plant-wide overhead rate based on direct labor costs, direct labor dollars. Here we're going to be looking for a percentage. The president has heard of activity-based costing and wants to see how the results would differ if this system were used. 2 activity cost pools were developed, machining and machine setup. Presented below is information related to the company's operations. So we have, for the standard and the custom, we have direct labor cost represented in dollars, and we have machine hours and setup hours broken down between the 2. Total estimated overhead costs are $240,000. Overhead cost allocated to the machining activity cost pool is $140,000, and $100,000 is allocated to the machine setup activity cost pool. So remember, what's important here is the cost pools have to add up to the total overhead, and they do here. 140 plus 100 is the 240 in total. So what are they asking us to do? A, compute the overhead rate using the traditional single predetermined overhead rate approach. B, compute the overhead rates using the activity-based costing approach. And C, determine the difference in allocation between the 2 approaches. So again, be careful what they're asking for here. They're not ultimately asking for a cost per unit. They're asking for the difference in allocation between the 2 approaches. What is the difference between the 2 approaches of how overhead is allocated? So A, they're simply asking you to calculate the single predetermined overhead rate. B, they're asking you to calculate the overhead rates using activity-based costing. So let's take a look at their solution here. A is asking you to calculate the predetermined overhead rate using a single plant-wide amount. And what did they say? Let's go back and read how it's calculated, right? The controller has decided to use a plant wide overhead rates based upon direct labor costs. Direct labor costs, you can see, are 50 for standard, 100 for custom, for a total of 150,000 versus total estimated overhead at 240,000. So when we look at the rate, remember what it is. It's overhead dollars divided by your activity, which in this case is direct labor dollars. You've got $240,000 of estimated manufacturing overhead divided by $150,000 of direct labor cost. So what they're telling you here is the predetermined overhead rate is 160% of whatever your direct labor cost is. Part B asks you to compute the overhead rates using activity-based costing. And we remember what that is. It's the cost pool dollars divided by whatever the cost driver is. So we have only two cost pools. We have machining and we have machine setups. If we go back to the problem, they're telling us here, of the $240,000 of total manufacturing overhead, 140,000 of it relates to the machining cost pool, and $100,000 of it is related to the machine setup cost pool. So we have machining. We got $140,000 as our numerator. But what's our denominator? Our denominator should be machine hours. So let's go back up and look where that number comes from. They have machine hours. They got 1,000 machine hours allocated to standard and 1,000 allocated to custom. So we need to know what the total activity base is. And the total activity base is the combination of both, which is 2,000. $140,000 for that cost pool divided by 2,000 machine hours. You have an activity rate of $70 per machine hour. Let's look at machine setups. So let's go back and look at where that number comes from. And the cost associated with machine setups, right, from down here is $100,000 is allocated to machine setup activity, that cost pool. How many machine setups do we have? We got 100 from standard and 400 for custom, which is 500. Machine setups, $100,000 cost pool divided by the 500 machine setups. The activity rate is $200 per hour. Okay, so that's part B, calculate the activity rates. Let's look at item C. Determine the difference in allocation between the two approaches. That is traditional versus activity-based costing. So let's first look at the standard. So remember how the standard is allocated. The standard is 160% of direct labor dollars, right? We calculated the rate here, the predetermined overhead rate, to be 160% of direct labor costs. So what's the direct labor cost for the standard? Direct labor cost of $50,000. $50,000 in direct labor for the standard times 160%. Manufacturing overhead allocated to standard is $80,000. Let's look at the custom. The custom has how much direct labor cost? Again, from the problem, $100,000 in direct labor cost The predetermined overhead rate is 160% of direct labor cost. 100,000 times 160%, $160,000. So that is how manufacturing overhead is allocated using a traditional approach. Now, one check figure is that what is allocated between the two products has to equal the total manufacturing overhead. Got 80,000 allocated to standard, $160,000 allocated to the custom. Add those two numbers together, you get what? $240,000. And that's what the total estimated overhead is, $240,000. So let's look at how it's allocated under activity-based costing. So remember, we've got activity rates. The first one is machining. And the standard has 1,000 machining hours. We calculated the activity rate above to be 70, so $70,000 is allocated to the standard. And there also happens to be 1,000 machine hours for the custom at $70 is $70,000. So again, as a refresher, the activity rate, $70 per machine hour, comes from here. And the breakdown of machine hours, 1,000 for standard and 1,000 for custom. The next activity rate is machine setups. And the number of machine setups comes from here again. The standard gets 100. The custom gets 400. And the activity rate we calculated to be 200 per setup hour. So we've got $20,000 allocated to the standard, and we've got $80,000 allocated to the custom. So under activity-based costing, we've got $90,000 allocated to the standard and $150,000 allocated to custom. And again, those two numbers have to add up to what? The total estimated manufacturing overhead. 90 plus 150 is 240. So we still don't know the difference. So the difference is what? It's right here, isn't it? The standard had $80,000 allocated to it under traditional, but under activity-based costing, it went up by $10,000 to $90,000. Under the custom, previously had $160,000 allocated to the custom, but it went down by 10 under ABC. So there was a shift of $10,000 between the two products by moving from traditional costing to activity-based costing. So please be sure to answer the question. The question was what? Determine the difference in the allocation between the two approaches. And the difference is $10,000. Let's look at another problem. This one is a bit more robust. And what I mean by that, there's a lot more going on. So let's read it. It says here, Combat Fire manufactures steel cylinders and nozzles for two models of fire extinguishers. One, a home fire extinguisher, and two, a commercial fire extinguisher. The home model is a high volume, meaning they sell 54,000 units, half-gallon cylinder that holds 2.5 pounds of multi-purpose dry chemical at 480 psi. The commercial model is a low volume. They only sell 10,200 units. Now, the number of units here is important because you're ultimately, at some point in time, going to be asked to calculate cost per unit. The number of units is important. And that's a 2-gallon cylinder that holds 10 pounds of multi-purpose dry chemical at 390 psi. Both products require 1.5 hours of direct labor for completion. They're telling you how many direct labor hours. Therefore, the total annual direct labor hours are 96,300. So this sounds like an activity base to me, right? How did they get it? 1.5 hours per unit multiplied times the total number of units, 54,000 for the home fire extinguisher and 10,200 units for the commercial one. That's how they come up with 96.3. estimated annual manufacturing overhead, $1,584,000. Thus, the predetermined overhead rate is $16.45 per direct labor hour. So they calculated the PDOR here for you. You don't have to calculate it. One single predetermined overhead rate. Total estimated overhead, $1,584,000 divided by the activity, which is 96,300 hours. They came up with $16.45 per direct labor hour. The direct materials cost is $18.50 for the home model, $26.50 for the commercial model. The direct labor cost is $19 per unit for both the home and the commercial models. The company's managers identified 6 activity cost pools and related cost drivers in accumulated overhead cost by pool as follows. All of that information has to be given to you. You're not going to create any of that stuff. It has to be provided to you. So what is really interesting here is the following. You've got the cost pools, the cost drivers, and they broke down the overhead into each of the cost pools. Remember, they said the total estimated manufacturing overhead was $1,584,000. Here's the total right here, $1,584,000. It's just broken down into multiple cost pools. So here is the estimated use of cost drivers. That's the total estimated. And here's the breakdown between the two products. And again, the breakdown between the two products has to add up to the total. For example, this receiving cost pool, the cost driver is pounds. They estimate a total of 335,000 pounds, broken down between the two products, 215 for home, 120 for commercial. Two of those add up to what? 335. And they do that with all the cost drivers. Again, all that information has to be provided to you. So what are they asking you to do here? They're ultimately asking you to do 3 things. Calculate the cost per unit under traditional, and then calculate the cost per unit using activity-based costing, and then ultimately, what's the difference? Is there a shift in the cost between traditional and activity-based costing? So A says, under the traditional product costing, compute the total cost unit of each product. So let's take a look at that. So it's a very short presentation. You're looking at product cost, which includes direct materials, direct labor, and manufacturing overhead. Again, direct materials and direct labor are not in question. Those are given to us and they will not change. The item that will change is the overhead component. So let's look at how they calculated manufacturing overhead. Remember, manufacturing overhead is, in a traditional system, the predetermined overhead rate multiplied by activity. They told us that the predetermined overhead rate in the beginning of the problem was $16.45 per direct labor hour. And they also told us in the problem at the very beginning, both products require 1.5 direct labor hours. There you go. Very straightforward. Predetermined overhead rate, $16.45. Takes 1.5 direct labor hours per unit, works out to be $24.68. So that's how they came up with the cost per unit for the home model and how they came up with the cost per unit for the commercial model. Item B asks you to calculate the calculate the activity rate for each of these separate activities: receiving, forming, assembling, testing, etc. Remember, it's the cost pool divided by the total expected activity for each pool Very similar predetermined overhead rate. Dollars divided by total activity. And you can see there are the rates right there. Item C asks you to allocate, to assign cost between the two products. And again, now you need to know what the activity is for each product. Again, this information is given to you. For example, receiving has 215,000 of the 335,000 activity, and commercial has 120,000 of the expected. Where does it come from? All comes from this chart, right? 215,000 pounds for home, 120,000 pounds for commercial. It's given to you. 215,000 pounds for home, 120,000 pounds for commercial, multiplied times the activity rate, which comes from that chart right there, which you just calculated. And they do that for all of the activities, all of the cost pools. They come up with overhead assigned to home of $1,086,500 and overhead assigned to commercial $497,780. You should check your math, because those two numbers should equal what? The total overhead for each one of these things. Okay. Well, we're interested in manufacturing overhead costs per unit. So we need to do what? Divide it by the number of units. So for home, they expect to have 54,000 units. For commercial, 10,200 units. Where does that information come from? Comes from the beginning of the problem, where they tell you the home model is a high volume, 54,000 units. The commercial model is a low volume unit, 10,200 units. That's where that information comes from. So that you're now able to do what? Calculate overhead cost per unit. Now, what do we need to do? We need to come up with cost per unit. And that means you have to add the three elements of product cost together: direct materials, direct labor, and manufacturing overhead. Materials and labor do not change. They stay exactly the same. And they gave that to us at the beginning of the problem. But see, now the home model overhead number is $20.12, which comes right from here, right? And the overhead for the commercial is $48.80. That's where it is there. So we have cost per unit. So what does item F ask us? Item F says, comment on one, the comparative overhead cost per unit for the two products and the comparative total costs per unit under traditional and ABC. So let's look at, for example, the commercial, the home product. Under the traditional approach, $62.18. Under activity-based costing, $57.62. The cost per unit dropped. And that's important because that's its high volume product. Let's look at commercial. Commercial was $70.18. It jumped up to $94.30. So what's really important here is, as I mentioned before, a company establishes the sales price of its product based upon its cost. If its cost is too high, likely the sales price is too high. And if the sales price is too high, they may not be able to compete. Again, what did we say? We said the home product is their high volume product. They sell 5 times more than they do of the commercial. It was having a cost at $62.18, and they developed a sales price based upon that number. But now they know that it only costs $57.62. So if the cost per unit drops, then the sales price per unit can also drop. But when it comes to the commercial, they thought it cost $70. But under ABC, it costs $94. So they're going to have to increase the sales price on that product. But remember, that's a secondary product. They should be concerned about their primary product. So that is essentially activity-based costing. And what you're going to watch out for is the shift in the allocation of manufacturing overhead. So thank you.